choosing the wrong investment type could quietly drain thousands from your retirement savings.
Here's what you need to know.
Eddie, how would you normally explain a mutual fund to someone?
A mutual fund is an investment tool that pulls money together from several different investors to put into this fund that's professionally managed in order to diversify those securities, stocks and bonds together. Most of them are actively managed. What that means is the manager thinks highly of a specific stock or bond or both or whatever, and they decide what they're going to buy and sell inside there, and they're doing so pretty actively, we would say. The other thing that you got to remember about mutual funds is that the value, because you have all these individual pieces inside of them, the value is calculated at the end of the day.
Yep.
They call that the NAV, the net asset value. That's what it's worth at the end of the day.
Right. Yeah, which is the total number of money. It's the total amount of money that's invested, and that's divided by the total assets.
Right.
Right.
And so, all those different assets have different.
Right. And so that's why that net asset value goes up and comes down. So when you buy in, you buy in according to whatever the NAV is.
You're buying the fund, not those individual securities.
Right. So what's the purpose? Why would a person need to? Why would it be wise? What's the utility of investing in mutual funds inside of your portfolio?
Rule number one when you're planning is that you're wanting certainty around your portfolio. We have to have certainty around the numbers so that we can make a plan in a very uncertain world, by the way. Stocks go up and down, bonds go up and down. We're trying to get that certainty as tight as possible, regardless of risk tolerance. It's just how much risk you're willing to take. But even a risky portfolio, we want to be diversified because it gives us more certainty around the numbers. The problem is if you don't have a lot of money, it's real hard to diversify a portfolio, especially with bonds, because bonds you got to buy in $1,000 lots. Right. If you have couple $1,000, real hard to get a fully diversified portfolio, and you run the risk of being too risky in that portfolio. So a mutual fund provides instant diversification at a much lower starting point. A lot of them you can get into like $250.
Yeah. And you can buy portions.
Correct.
You can buy portions. You don't have to buy the entire amount.
Right.
You can buy portions of. There's even some investment products that require $100,000 to buy into that. There are some that require even $1 million. And how many individual people can do that?
Right.
Not many. But if you take a bunch of individuals and they all come together, pool their money together, they can start investing in these more advanced products that have different values and different utilities to them.
And it can be a low-cost way to get professional money management, even if you're doing it on your own, like in a 401k, for example.
Great utility.
Yeah.
Great utility.
Because you get professional money managers inside these funds that are doing those things.
But no investment product is perfect. None of them. Every one of them has their benefits, or else they'd have no value. Then again, every one of them has their risks, or else everyone would invest in just that investment product because there's no risk. But every investment has a risk. What are some of the reasons why a person wouldn't use a mutual fund, or some of the drawbacks?
Well, one, just jumping out on the surface, a lot of people like to have their hands on the reins. They like control.
Right.
They have control bias. Everybody has a degree of that. So you give up control. You're not going to be picking what stocks or bonds or investments that the manager chooses inside of there.
You picked the mutual fund.
Right, which from a study standpoint is probably a good thing for most people. But you do give up that control. If it's an investment account that's not tax sheltered, so think of like a 401k or an IRA or a Roth IRA. Those are tax sheltered. So as the money grows, you're not having to pay taxes on it until you pull that money out. Except for the Roth. The Roth will grow tax deferred and can be tax free later on. But if it's in a normal brokerage account, where as it's growing, a lot of times these mutual funds, by law, they get to a point where they have to pay out what they call a capital gain. And sometimes those capital gains, especially in really good, solid years, you have back-to-back really good years in the markets, that capital gain can be quite sizable. And so you end up paying those taxes. That becomes a drag on the portfolio at that point. Another thing you got to look out for is some of them get quite expensive.
You mean people don't work for free? Those managers don't work for free?
Even in a 401k, I've seen some of these funds, they're charging 1% or more just to manage the portfolio. And so in some cases, it's worth it. Some cases it's not, but they can be expensive. So watching those internal expenses, really important. And then, like we said earlier, that NAV, that net asset value price, that only comes in at the end of the day. So mutual funds are not a good trading tool. It's not something you can jump in and out of at any given time.
Yeah. So there are some other products. There's another investment product that oftentimes it's characterized somewhat like a mutual fund, but it's called an exchange trade fund. So an ETF.
Right.
So can you talk a little bit about what an ETF is, what its utility is?
Yeah. Very similar to a mutual fund, still baskets of securities. There's still usually a manager that's over that particular type of fund. So you can still get diversification. They come in different forms than mutual funds typically will. So sometimes you can have an exchange traded fund, which gets a little confusing. An exchange traded fund that just mirrors an individual stock's performance. So you don't own the stock, you own the fund, but it's just trading in conjunction or sometimes against the fund or something in that vein. Yep. So they come in different types. Many of them are passive investments, meaning that the manager, they're buying things and they're selling things sometimes, but it's not at the same frequency or rate that a mutual fund would. But active managed ETFs are getting more popular. There's starting to become more of them out there. The value of the fund fluctuates throughout the day, so you don't just get the price at the end of the day.
It's not a forward price.
Based on supply and demand throughout the day. Yeah.
What's the utility of it? How is an ETF useful?
Well, one of the big ones is from a tax perspective. Okay. From a tax perspective, they don't have the same rules around paying those capital gains out that the mutual funds do. And so in those brokerage type accounts, sometimes they can provide you with more tax efficiency. So you're holding on to more of your money and not having as big a tax bill at the end of the year. Like mutual funds, they still provide good diversification.
So they're not all just tracking, you brought up one kind of an ETF where it tracks the index of a single stock, or you could have an ETF that tracks the index of a market.
Like the S&P 500.
Like the S&P 500.
Yep.
Okay.
ETFs also are lower cost than a mutual fund. They tend to not cost as much because they're not as actively managed and things like this, and they're traded on exchanges. And because they're traded on the exchanges, the value is a little bit more transparent throughout the day. So as long as there's a buyer on the other end, you can sell that exchange traded fund. So if you want out in the morning and there's a buyer, you can get out. So from a portfolio management standpoint, it gives the manager more flexibility on when they want to sell that security or fund.
Because a mutual fund is not sold on the secondary market. It comes as an issue from the issuer.
Right.
And so you're dealing directly with that issuer. With an ETF, you're dealing with other investors because once those funds are bought, then they're traded, bought and sold on the exchanges from investor to investor.
Right.
With that being compared here with an ETF, an exchange trade fund, and a mutual fund, let's just play real simple math here. If I make $1 in my mutual fund and I make $1 in my ETF, well, mutual funds are typically going to have some higher costs to them. So even though I make $1 in both, that doesn't mean I'm going to keep $1 from both.
Right.
I'm going to pay those fees. And in the end, a lot of times that ETF, you're going to keep more of that.
Yeah. And that drag happens internally inside the fund. And so most people don't even know it's there. They don't see it. Now, the prospectus that everyone gets issued every year that nobody ever reads.
Right.
I get phone calls all the time. Hey, do I need to keep this? And I'm like, well, I can't tell you no.
Right. Yeah, because that prospectus tells you all about that
Right.
fund. It tells you all about what happens with it, what it's invested in, the fees that are internal that, again, a lot of people, they're unaware of. But
Right.
ignorance doesn't mean you don't get
Well,
charged
because,
for
you
it.
know, people look at the bottom line and saying, oh, that's doing really, really well until it's not. And there's no basis of comparison.
That's right.
Because all you can do is compare one bottom line to another, but it's not always apples to apples.
Right.
And that's the trouble is if you compare this fund to this, well, maybe they own some of the same things, but in different quantities. They were traded, some of the timing on those trades. And so really you have to look at longer periods of time.
Mm-hmm.
I always go back to this. It's not over the short term. And in my world, short term's like 5 years or less. So when you're dealing with long periods of time, 10, 15, 20-year periods of time, what you find is apples to apples, most of these money managers are about the same. So if you can save money on the costs, huge benefit.
Right.
Right.
It's kind of shifting here back to another vein that we've talked about. No investment tool is without its benefit, and none of them are without their risk. Okay. So what are some of the drawbacks of exchange trade funds? We talked about the benefits.
Well, as we sit here today, there's not as many of them.
Okay.
There's a lot more mutual funds out there to choose from. So if you're trying to build a whole portfolio, there's a lot more choices from mutual funds than there are exchange traded funds. But there's more and more coming on market. They become more and more popular, especially because of cost. People are getting educated on that through things like the podcast and different sources online. Some ETFs are really levered. So what do I mean? If you have one, for example, an exchange traded fund that mirrors the S&P 500 as far as the investments inside of it. But when the S&P 500 goes up 1%, the ETF can go up 5%. That's what we talk about levered. So for every one over here, you're actually getting 5, which sounds great. But on the flip side, it's like for every 1% down, you're down 5 times as much. So a lot of people aren't aware of the risks that are involved with some of those kind of products. People buy and they don't really understand why or what they're buying. Everyone wants the upside. They don't always look at what the downside risk of those things or how it really functions or fits within a portfolio or why you'd buy it to begin with. That's one of the big ones that I would say.
We've talked about both mutual funds and ETFs or exchange trade funds, talked about their benefits, talked about their drawbacks. And so let's do a little bit of comparison, say which is better. And I'll start the answer off by saying it probably just depends. Depends on what situation you're in, what utility you need.
Yeah. At the end of the day, the truth is probably that a mixture of both makes sense because sometimes it makes sense to have some active management in a portfolio and sometimes it doesn't. So let me give you an example. If you take a stock like Apple, one of the most widely tracked and followed stocks in the world, there's a lot of analysts covering that, a lot of information that's out there in the public. And so very unlikely that there's going to be any kind of information that somebody can make a trade that's going to get ahead of something from Apple or something like that. So those large companies probably make sense to have some passive management because they're just good companies. They're probably going to grow over time. Having a basket of those. So why pay a huge expense ratio or a fee inside that fund when you could just save the money and get the same benefit?
Right.
On the flip side, you talk about smaller companies, not as widely followed, not as many analysts covering it. And so the likelihood of a portfolio manager picking a stock that's small over another one and basing it on some opinion information and being able to get that trade right, there's a bigger likelihood of that. So it might make sense to have an active manager in there doing that research for you to help maximize a gain there for you. Right. So that would be my answer would be probably a mix of both makes sense. Plus, there's some mutual funds that do some really neat things that they don't always have an exchange traded fund that does. So by doing that, you help reduce the overall cost of the portfolio because it's the weighted average of all those costs instead of it just being all mutual funds or all to ETFs. It lowers the overall cost that you're paying. From a tax standpoint, it might not make sense to have either of them. So if you're in a really high tax bracket and you own a brokerage account you're going to be paying taxes on, you're not going to get much of a benefit from owning mutual funds and ETFs from a tax management standpoint. So what do I mean? Well, if you own the individual securities, again, remember, if you own the fund, you don't own the securities and you don't have control over the securities. When you own the stocks, however, then you can do some cool things like gain loss harvesting where you sell off one and buy another. Don't have to completely get out of the markets to do these things if you're doing them right. But you save so much on taxes doing it that way. So maybe having none of them makes sense in certain accounts.
Right. So having a well-balanced portfolio can really address your specific needs. It's important to have a good financial manager that can help optimize your investment strategies and use the different investment tools that can balance out your investments and that can help achieve your goals in the most optimal way possible.
So the right mix can save you thousands over the course of your investing life and retirement. If you'd like a second opinion on your portfolio, we'd be glad to help.